Hello, everybody. Welcome to today's episode of The Daily Dose. Today is Wednesday, November 2nd, and we got to hear from the Federal Reserve and Jerome Powell today. They raised interest rates by 75 basis points for a fourth consecutive month. And Powell also said that it is very premature to talk about a rate hike pause. So I do think that the market was expecting him not to be as hawkish as he was, and that's why we saw the sell-off near the end of the day. Before we get into it, though, I'd just like to say that if you like this type of content, please subscribe on YouTube and follow us wherever you listen to podcasts. I release an episode like this every single day that the market is open, and I release an episode over the weekend that goes a little bit more in depth on some things happening in the markets. So the U.S. Federal Reserve raised interest rates Wednesday by 75 basis points for the fourth straight meeting, while hinting at a potential slower pace in the future. And then Fed Chair Jerome Powell reiterated the central bank's commitment to raise rates further in an attempt to tame multi-decade highs in inflation. Quote, "In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments," the policy statement said. So really, Jerome Powell wanted to reiterate that he's doing everything he can, the Fed's doing everything that they can to slow down inflation, and they're not really thinking about pausing rates yet. They're going to continue to raise rates and stay as hawkish as needed to get inflation under control. So stocks turned green initially after the statement, then fell as Powell repeatedly told reporters that the Fed still has a ways to go in its fight against inflation. Quote, "It is very premature, in my view, to think about or be talking about pausing our rate hikes," unquote, Powell stressed. Quote, "We have a ways to go in our policy. We need ongoing rate hikes to get that level of sufficiently restrictive territory. And of course, we don't know exactly where that is. I would expect us to continue to update it based on what we're seeing in the incoming data," end quote. The rate hike brings the central bank's policy rate, the federal funds rate, to a new range of 3.75 to 4%, its highest level since 2008, from a current range between 3% and 3.25%. In the press conference, Powell stated that interest rates may need to rise above the 4.6% previously estimated. And that's really why we saw the stock market sell off at the end of the day, was because of what he was saying right here. So 4 75 basis point rate hikes in a row is unprecedented since the Fed explicitly started targeting the federal funds rate to conduct monetary policy in the late 1980s. Wednesday's announcement brings the rate to a level not seen since the end of 2007. The vote was unanimous. So that just goes to show that everybody's on board here. Once the policy rate reaches what the Fed feels is a sufficiently restrictive level, they would maintain that level for some time until there was compelling evidence that inflation was on course to return to 2%. So, I mean, it doesn't look like they're easing up anytime soon, and this is definitely more hawkish than what the market was expecting. Asked about whether it's become more difficult to engineer a soft landing, in other words, avoid a painful recession, Powell stated, "The inflation picture has become more and more challenging over the course of this year. That means we have to have policy more restrictive, and that narrows the path for a soft landing." So this is the most hawkish, in my opinion, we've heard Powell. He's saying that, hey, the soft landing, that window is becoming smaller because we need to get more restrictive to get inflation under control. Maybe we need to be more restrictive than we originally thought. Maybe we need to keep rates higher for longer than we originally thought. And I think that's where they're heading. And I don't think that's good for stocks. I think we could definitely see a new low. And we'll take a look at the charts in a second. Powell also acknowledged the slowing of economic growth while stressing that interest rates would have continued rising given that the labor market remains out of balance. Fed officials see the job market as strong, pointing to robust job gains and a low unemployment rate. At the same time, the job market appears to be cooling. Job openings fell sharply in August, and the job quits rate is trending lower, while fewer new jobs are being minted on a monthly basis. Economists project that Friday's job report will show that 200,000 non-farm payrolls were created in October, a result that would be down from the 263,000 jobs created in September and down from the monthly average of 420,000 in 2022. So that's what happened today. Basically, the Fed's more hawkish than what the market was expecting. We're going to see continued rate hikes. Maybe we'll go higher than what we thought the terminal rate was going to be. Maybe we'll keep the rates higher for longer, but either way, this isn't what the market wanted based on the price action that we had seen. So let's take a look at the chart. So this is the S&P 500. It was already a red flag that we were sitting on a resistance going into this meeting. We knew it was going to be tough. And interestingly enough, during the meeting, we came and we touched exactly at the bottom of this zone. That's how you know you have a good level. We touched exactly at the bottom of this 38.95. And then as he continued to talk about how they were going to remain to be as hawkish as necessary, and that maybe the terminal rate is going to be higher than originally expected. We might go to near 5% or higher. And that maybe the window for the soft landing is closing and that this might be a painful recession. We sold off. So I wouldn't be surprised to get back down to these levels here in this zone for sure, at least. And then down, maybe we test this 34.95 that the market made a low at. And then after that, honestly, I'm still looking at the 32.50. I think the 32.50 is a good next leg down for the market. I think we could definitely get there. I don't think that the market's going to like what happened here. And I think usually what's happened after the Fed talks, like up here, it sells off aggressively and it gets to that next zone and then it makes a base and it waits for them to come back. It gets optimistic that they're going to pivot and then it sells off. So I wouldn't be surprised if we have an aggressive sell-off down to at least the 34.95, but if not the 32.50, and then we make a base here and until we hear from them again. So that's why I would be looking to for sure. I don't see us going higher from here. It really wouldn't make sense to. The market, again, was rallying based on the fact that it was expecting the Fed to still raise interest rates by 75 basis points, but that we were going to get something a little more dovish, that they were going to say, we're starting to see that inflation maybe have peaked, and we're going to slow down our rate hikes. It's not what he said. He said inflation is looking tough, and we need to keep being aggressive for a long time. So again, I mean, you definitely could have seen this coming, but it's still not great for this market in general. But you definitely could have expected it. It was definitely, I'm not really surprised at what happened today. But let's take a look at Bitcoin. And I just want to say, by starting out here, is just the fact that this is still trading in such lockstep with stocks right now just goes to show how early this asset class is in general. And I will say it's definitely still possible that we see 12,000 to even sub 10,000 at 9,000. But I mean, now is the time. If you're interested in this space, you're learning about this space, you're thinking about investing in this space, I do think now is a great time to start investing in this space. Maybe not to go all in, because I do think we could still go up to 50% lower in Bitcoin. But I mean, I've been adding to my Bitcoin position throughout this crypto winter, through this Bitcoin winter. And I have a little stash saved up to buy if it hits those target prices that I have, but I've still been adding, and I think it's a tremendous asset. It's going to be an extremely valuable asset class for decades to come. And obviously these are we're getting to great prices right now. So, but it's still in its range. Nothing really new here. It's heading back down to this level of support. Again, if we break through this support, you all know where my next price target is, $9,000 to $12,000. that's what I'm looking at on Bitcoin. But in general, I'll just recap by saying a little bit more hawkish than what the market was expecting from the Fed. They're starting to see that maybe we might need a painful recession, more painful than they originally thought. Maybe a soft landing isn't going to happen. And maybe rates might be higher for longer than what people were expecting. So I hope no one listening or watching this episode got burned today. I hope you're all able to make good trades, good investments throughout this difficult time. I'm going to leave it here. Make sure to stay tuned throughout the rest of the week and this weekend. And I'll just say, if you like this type of content, please subscribe on YouTube and follow us wherever you listen to podcasts. It would really mean a lot. And until next time, thank you for listening.